Welcome to Fibocan's YouTube channel, Module 1 Banking. We will start with this. This is the first of the very series of modules that we are going to conduct in this overall training program. This is going to be really useful to each one of you. As always, our LinkedIn details, YouTube channel details, Twitter ID and our website details for reaching out to us for further training programs are given over here. Target audience. Who are the target audience? Target audience, any graduate, anybody who is doing graduate, BA, BCom, BSc, any graduate. In fact, we go to the extent of saying that even an undergraduate can attend this, because after all it is going to enhance one's finance knowledge. Anyone attending interviews, particularly in the banking and financial service sector or BPO sector, house managers, because they are an important role they play in the overall economic system. Anyone interested in enhancing banking and finance knowledge. With target audience, takeaways. What is the takeaway? Ultimately, there has to be a takeaway, right? Somebody is seeing this video and there should be a takeaway. What is the takeaway? After seeing this particular module, banking, one will develop a very good understanding of banking concepts, basics of banking concepts, balance sheet of banks. Then fiscal and monetary policy, basic understanding of what is fiscal policy, who is responsible for fiscal policy and who is responsible for monetary policy. Then banking structure and financial institutions categories. What are the various categories of banking and financial system categories? Transformation in banking that happened in the last 2 decades, particularly. History of Indian banking and financial services sector. Then dramatic transformation in students' confidence level, that's very important, on investors' confidence level. That's the takeaway. Having seen the takeaway, let's straight away jump into banks. What is a bank? As you are seeing in slide 4, what is bank? In the picture we have clearly shown, bank is an entity that connects the depositors and the borrowers, or people who are saving money and people who are in need of money. Simple. That's the basic concept of banking that has started 300 years back, and to the known future it is going to be like this only. Whatever they can do, add-on products, but the basic of banking remains the same. So what it means, the deposit holder, people who are having surplus money or who want to save, they go and deposit money with the bank, and bank gives them interest to the deposit holders. Now bank gets this money and it has to lend it to the people who are in need of money. Those people, they are called borrowers. The difference in the interest paid by bank to the deposit holders versus the interest that it earned from the borrowers is called spread. In fact, the profit of any bank is this. That is how a bank thrives. Bank's business is, core business is only this. Anything else is on top of it. So many times we have been a depositor, we have been a borrower also. But whatever we does, a depositor is a depositor, and also the depositor, she not only gives the money to the bank, she also gives the right to the bank to utilize the funds in whatever way bank thinks fit to lend to the borrowers. However, the depositor has to be given the interest even if borrower does not repay. That is the basics of banking. Hope you all understand the basics. Now, what are the types of services are offered, and what are the account types? Services, there are 2 types. One is the fund based and other is the fee based. What is fund based? A simple deposit is a fund based, like a fixed deposit or savings deposit or a recurring deposit, because the deposit holder, she gives the money to the bank, asks the bank to give interest along with the capital that is deposited at a certain period of time, and ask the bank to utilize the funds in whatever way it wants. So this is fund based. Then what is fee based? So many times we use locker facility with a bank, or we take demand draft with the bank. These are all fee based because we avail the services and pay the service charge. That is called as a service charge. These are the 2 services offered by bank. Then what are the types of accounts, particularly from a deposit side? Demand deposit and time deposit. It is also called a liability. What is demand deposits? Any deposit that the customer can demand at any time. Example, a savings account or a current account. Typically, they call it as CASA, current account and savings account. They are typically a demand deposits Because the customer can walk in any time and ask for the money. In fact, customer need not give an advance notice to the bank, and they can withdraw the money either by cash or through check or through clearing in any form, whatever they want, or even through an online transfer. Hence, that is called demand deposit. What is time deposit? The deposit expires upon maturity of time. Example is fixed deposits or a recurring deposit. Of course, the deposit will mature only upon the expiry of the time, but customer can withdraw at any time. But in normal course, no customer will withdraw a demand deposit unless otherwise she or he is in demand of money. Otherwise, they are going to continue with the deposit. Hence, bank knows that demand deposits are readily withdrawable by customer, while time deposit, the liability arises only upon the maturity of the time. That is the difference between demand deposits and time deposits. It is also called demand liabilities and time liabilities. Why? Because the bank is liable to pay the depositors at any time. Hence, this is a liability. Now, let us understand the clearing function. As you can see in the picture, clearing house, how it happens. Let us take a simple example. Customer X, and there are two persons, friends, X and Y. So, X is a customer of bank A and Y is a customer of bank B, as you can see in the picture. So, now Y has given a check to X. So, now X is a customer of bank A, whereas bank B does not know X. Then how X can collect the money from bank B? So, what X will do is, X will go and deposit the check in his bank account, which is bank A, and then give it to request the bank, please clear the check from bank B and credit my account. So, now what bank A will do is that it will participate in a clearing house function. So, where all the checks that are withdrawn on all the other banks will be deposited by bank A in with the Reserve Bank of India. So, likewise, other banks will also deposit all the checks drawn on bank A. Now, in this example, customer X check is now given to bank B. Bank B, it will go to the bank B on day 2. So, day 1 they deposit, the customer X gives the check to bank A. Day 2 it will go for day 1 evening it will go for clearing, and day 2 morning it will be debited in the customer Y's account. Bank B will debit if balance is there and if signature matches and other technical details are matching. Like for example, the validity of the check should be 3 months. If once all these things are matches, then bank B will debit the customer's account and intimate bank A that yes boss, this is debited, you can credit customer X. Of course, this does not happen, but if there is no check that is returned on the next day, it is assumed that the check is passed. So, now customer X got the check cleared through the clearing house function. This is the basic function of clearing house. I am sure that this is going to help you in a lot, particularly when we see in the module 2, module 3 where stock market trading and settlement, this clearing house function will help you a lot. Now, let us look at the bank's balance sheet. What is the bank's balance sheet? Normally, sources of fund and deployment or uses of fund. What is sources of fund? Capital. Typically, capital is a source of fund, right? It is a liability because it is shareholders' money. Then next is client deposits, net demand and time liabilities. As you have seen in earlier slide, where demand and time liabilities or demand and time deposits. So, that is a demand and time liability, that is a source of fund. Bank gets source of fund. How the funds are deployed? One, loans to client, that is what we saw in slide 1 itself, where the interest is earned by bank, which it passes on to the deposit holders, and the difference it keeps, that is called the spread. So, then the cash reserve ratio. So, these are all we will discuss what is cash reserve ratio and liquidity ratio, statutory liquidity ratio. So, this is how your typical bank's balance sheet is there. Of course, I have not shown the exhaustive bank's balance sheet because the intention is not to teach accountancy here, to know you the basic concept of banking and the balance sheet. Let us now look at the role of RBI. What is RBI? Reserve Bank of India, or it is called as a central bank. Every country has a central bank. So in US it is called Federal Reserve. In Australia it is called Reserve Bank of Australia. In India it is called Reserve Bank of India or RBI. RBI, it has two important roles. One is that it ensures that it maintains maintaining growth and orderly economic development, regulatory and supervisory function, and lender of last resort. Why it is called lender of last resort? Because RBI is called bankers bank. Why? Because individuals like you and me or any company will have bank account with any of the commercial banks. Whereas commercial banks, they maintain bank account with Reserve Bank of India. Hence, Reserve Bank of India or RBI is called bankers bank, and they are called lender of last resort. Why they are called lender of last resort? Many times when banks are in financial crisis, when they don't have funds, and when there is short term asset and liability mismatch, where they are in need of funds, they can approach Reserve Bank of India, and who will ensure that the liquidity crisis is overcome. Hence, they are called lender of last resort. So, this is the simple function of Reserve Bank of India. So, let us now look at the Reserve Bank of India and central government. What is the role played by them in the overall economic development and growth? So, Reserve Bank of India is responsible, or for that matter in any central bank is responsible for monetary policies in a country, whereas the fiscal policies are regulated and governed by the government or the central government in our case, in Indian case. What is the monetary policies? As you can see in slide 9, monetary policy is, one is lending norms, then currency management, monetary policies, cash reserve ratio and liquidity ratio, which we will see, open market operations, then treasury bills, bonds auctioning. Lending norms. So, what happened? Typically, banks, Reserve Bank of India regulates each and every bank and ensure that they adhere to the lending norms. There is some priority sector lending, a certain percentage of lending has to be done to the priority sector, small farmers, agriculture, artisans, and small players, because the lending to small artisans and farmers and priority sector will trigger overall economic development, and also they have been left out of the banking system for quite some time, and there has been inclusive growth, inclusive banking growth, which is why Reserve Bank of India stipulates lending norms which every bank has to adhere to. That is called lending norms. Currency management. Other than Reserve Bank of India, RBI, nobody can issue currencies. If anybody does, it is illegal. So, RBI is the only one who can issue currencies in India. Monetary policies, cash reserve ratio and liquidity ratio. Let us go to next slide to see this. As you can see in the picture, CRR and SLR. What is CRR? CRR is nothing but cash reserve ratio, and SLR is statutory liquidity ratio. So, basically Reserve Bank of India regulates each and every commercial bank, every bank, to keep certain percentage of funds in the form of cash with Reserve Bank of India, that is called CRR. The ratios vary from time to time. Today the ratio is somewhere around 4.6 or 4.5%. And SLR is statutory liquidity ratio. So, RBI approved securities or cash or other currencies where it can be kept, but it has to be mandatorily kept with Reserve Bank of India. That constitutes another 18%. That means every bank, out of 100 rupees deposit that they collect, 22 or 23% they cannot lend freely. They have to keep 4.5% in the form of cash reserve ratio, and another 18% or so in the form of SLR. Why? You might wonder, no, why Reserve Bank of India controls bank? Yes, it is controlling because in a country any business can go bust, can go down, but not the banking, because if banks go bust or banks people don't have trust on bank, the entire economic system collapses, the entire country collapses. Hence, governments and Reserve Bank of India or central bank puts lot of regulations and controls in ensuring that CRR and SLR norms are adhered to. So, each bank has to keep their net and demand liabilities are roughly around 22% in the form of CRR and SLR. That is to ensure that the depositors' interest is protected, the interest of the country is protected. So in our country also, many banks, when they were on the verge of going bust, the various governments and Reserve Bank of India has come to the rescue of not only the bank but also the depositor holders and also for the interest of the country. Now let's go back to the earlier slide where monetary policies, open market operations. RBI conducts open market operations, repos and reverse repos. Basically, it is a type of liquidity management. When RBI finds there is excess liquidity in the system, it will sell government securities to banks and remove the take the cash from the system. The same is done vice versa, where it wants to inject liquidity, it will buy Reserve Bank of India, when it wants to inject liquidity, it will buy bonds from banks, commercial banks. Therefore, money will go into the banking system, which will be injected into the economic system, which is why it is called as open market operations. Then treasury bills and treasury bonds auctioning. This is central bank on behalf of various state governments. Reserve Bank of India conducts treasury bills auctioning and bond auctionings. So this is called the monetary policy. Fiscal policy. What is fiscal policy? Fiscal policy is simple. It is budget. Basically, income and expense of a government. That is called fiscal policy. How the government manages its income and expense. In what way it wants to collect income. What is the ways of income? The income is in the way of taxes, direct taxes like income tax, or indirect taxes like GST and other taxes. So these are the forms in which government collects its revenues. Sometimes the government can think, no, I will reduce the income tax rates or reduce the GST rates or other excise rates, but I will widen the tax net. Like for example, the tax rates can be income tax, simple example, income tax rate can be brought down, but instead of anybody above 5 lakhs, anybody above 3 lakhs can be taxed. Or it can decide that no, I will increase the limit from 5 lakh to 7 lakhs, but I will increase the tax rate. These are some of the ways and means I am telling. I am not saying recommending anything here. I am just giving the ways and means in which government can collect its revenues. Likewise, the spending, the expenditure, how the government wants to spend. Social infrastructure, physical infrastructure, defense, healthcare, education. So how much portion it wants to allocate. During corona times, there is unforeseen expense that government had to meet, where they had to meet the ration requirements of every citizen, most of the citizens of the country, and they have to ensure that people are airlifted during crisis and other times. All these things are what you call expenditures government manages. So planned expenditure and unplanned expenditures. So fiscal policy is basically, in a nutshell, how government manages its income and expense in a particular year. Then there are other government directed programs. Example is Manrega is a simple example which all of you might be aware of it. So these are all the fiscal policies. Hence, government and Reserve Bank of India work in close tandem, work hands to hand, and ensure that the fiscal policy and monetary policies are closely knitted together, so that there is an overall economic development, orderly growth, and wealth development and employment generation. That is the overall intention of Reserve Bank of India and government. Now, having seen that, we have seen this SLR, CRR. Let's look at the banking structure, how the banks are structured. The regulatory body, as I said, is Reserve Bank of India. Within Reserve Bank of India, we have public sector banks, private sector banks, foreign banks, NBFCs, non-banking financial services. So what is public sector banks? Any bank where the majority of ownership, more than 51%, is held by government. Example can be like your Bank of Baroda, State Bank of India, Canara Bank, and so on and so forth. Private sector banks, HDFC Bank, ICICI Bank, Karur Vysya Bank, IndusInd Bank, many banks are there. I am just giving an example, that's all. ICICI Bank, then Federal Bank, so many private sector banks are there. So they all are private sector banks. Foreign banks, Standard Chartered Bank, Citi Bank, HSBC, Hong Kong and Shanghai Banking Corporation. So many such banks are there. So all of them are under the control and regulation of Reserve Bank of India. Even if a private sector foreign bank is there in India, their Indian operations are subject to regulations by Reserve Bank of India. They cannot say that no, I am a foreign bank, I cannot be regulated by RBI. No. Their Indian operations are strictly regulated by RBI and the RBI rules and regulations and norms. And they also have to adhere to the lending requirements, priority sector, SLR, CRR, and all those things. Foreign banks, we explained. NBFCs, non-banking financial services, they play a major role in the overall economic system. Hence, any NBFC that is mobilizing deposits, Reserve Bank of India regulates it. That is the banking structure. Now let's look at banking and financial categories. What are the various categories? See, there we saw only banking. Here we are seeing the financial institutions also. As you can see, Reserve Bank of India, within which it regulates all the commercial banks. Then you have SEBI, Securities Exchange Board of India. It regulates all the capital market entities. When we see in the next module, we will be discussing in details, but at this point in time, I just want to say whom they regulate. IRDA, Insurance Regulator Authority, they regulate all the insurance entities. Then you have development financial institutions like SIDBI, the Small Industrial Development Bank. Then you have NABARD, National Agriculture Bank for rural development. All these are all development financial institutions. So overall, all these play an important role in the overall economic development and growth. Now, banking services, new millennium. As I said, how the banking has been transformed in the last 20 years or 2 decades. So earlier there was manual tellers. One can, if you are in early teens or mid 20s, you can check your parents or grandparents, they will tell you stories. Earlier there were manual tellers. So people will stand in queues to withdraw money. Today that is done away with. We are having ATMs, automatic teller machines. Anytime, anywhere you can withdraw money. Then you have debit cards and credit cards. So it is ease of banking. At par checks. Earlier, there was no at par checks. If you are sitting in Chennai, you want to withdraw money from, if you have a check that is issued in Mumbai, you have to send the check to your bank. That branch will then send it to their counter bank in Mumbai, and there it will participate in Mumbai clearing. Then it will collect the money. It will take, the entire process will take 10 days. Today, it is at par checks. Anywhere, anytime banking. Today, you have 24/7 banking. Anytime you can withdraw money. Customer of the bank. Today, you are the customer of the banking system. Earlier, you are just customer of the branch. So, you can check with your grandparents. So, they will tell you stories. Earlier, if I have an account with a particular bank's branch, I was just customer of the branch because my data was available only within that branch. So, I am not even a customer of the bank. Today, you are a customer of the banking system. Why? You have let us say X bank. You can go to Y bank and withdraw from that Y bank's ATM. So, you are a customer of the banking system, not just restricted to your bank. So, that is how the technology has evolved in the last 20 years. Today, you have faster, safer, cheaper fund transfer methods like NEFT, RTGS, IMPS and UPA. UPA India, every Indian has to be proud. Our government has done a fabulous job in promoting UPA, and UPA is the best payment system in the world. So, each one of us have to be proud of it. You have mobile banking, M-banking, then video and digital banking. All these have happened in the last 20 years. Dramatic transformation that has happened in the last 20 years. Now, finally, we will see the history of Indian banking and financial services. Always history of any individual, any country is important. So, here in the financial system, it's important. I will just discuss about the chronology of events that had happened. 1935, in fact 1934 Reserve Bank of India was set up, but RBI started operations in 1935. 1955, the Imperial Bank was converted into State Bank of India. 1956, Nationalization of Insurance Company and LIC Act was formed by the Act of Parliament. 1963, UTI was established. Many of you might not aware. In fact, the first mutual fund in India is one can think of is of UTI. UTI Unit 64 can be thought of as the first mutual fund. So, 1964, first unit scheme launched by UTA. Then 1969, 14 banks were nationalized by the then Prime Minister. So, that was a major milestone in the banking history. So, why it was done? Because banking was restricted to select few people and only in the urban pockets. So, taking the bank to the unbanked areas, nationalization was the need of the hour. Hence, it was done in 1969. In 1980, again, another second round of nationalization of 6 banks happened. So, that is an important event. 1991, we started reversing liberalization of Indian economy. See, it's all with time we have to change. There is no right or wrong. At that time, that was the need. In 1991, the entire globe was integrated. China was integrating with the Western world. We had to open up our economy. Of course, liberalization itself is a separate topic. I don't want to go into that in detail. So, liberalization happened. Post 1991, many new private sectors banks came in. HDFC Bank, ICA. Today, all the major private sector banks you can think of came post 1991. So now, new millennium, what is happening? Merger of SBA, public sector banks. So earlier we made private sector banks into public sector banks. Now we are merging and consolidating all public sector banks and creating big 3 or 4 or 6 public sector banks that will compete with the private sector and foreign banks. And 2017, merger of SBI associates banks with SBI. So earlier there were SBI and 7 associate banks. Everything was merged into SBI in 2017. That is the development that happened in the history of banking and financial services. I am sure with this kind of input and the basics that you are given, it is going to give you a good idea about the banking concept, and with our subsequent modules, it will really help you in enhancing your overall finance knowledge. Thank you very much.